Good evening, everyone. Thanks for showing up, especially if you're in a snow blanketed area of the country. If you're not, you're lucky. You probably had a nice Sunday. Although Luann and I are both in the Northeast. I'm outside of Philadelphia. Luann's you're outside of
Virginia.
Virginia. And we definitely got snowed in today. Actually, it was still nice because it was a nice quiet day, but we were just talking how we're now getting the sleet. So that might not be as nice for tomorrow, but we'll deal with it. And whoever who showed up right now, thanks for being here. Hopefully you're nice and cozy. And before we get started, if you could put in the chat where you're watching from and what year in high school or college you have a student, because we sent this invitation out to parents with both, high school and college students. And for those of you who don't know me, I'm Debbie Schwartz. I'm the founder of Road to College and the Paying for College 101 Facebook group. And I'm here tonight with Luann Lee, who is the founder of Your College Planning Coach. And Luann has been advising parents on both college admissions and college financial planning for many years. You can share how many years, Luann. I don't want to disclose um, too much. But tonight, thank you, everybody. I see you putting into chat. Really appreciate it. But tonight, Luann actually asked if we could run this webinar. And so I appreciate her bringing up the topic about Parent Plus loans because there's lots changing really related to the BBB, big beautiful bill that was passed this past summer, and we just want parents to know what the impacts are. And while you still have time, if you want to take advantage of some things or just understand what might be happening over the next year, so that you can make smart decisions. So that's what this whole session is about tonight. It is really related to Parent Plus loans, if you have them, what your opportunities may or may not be. And with that, I'm going to tell you, I am not an expert on this. I don't know the details at all, as well as Luann. So I am going to pass it off to her so she could get started. She's got some slides to share. She has a case study to also share, and then we will answer questions. So thanks, Luann.
Sure, Debbie, and thank you for the introduction. And I see, as everybody was putting into the chat where they're from, a lot of us are snow or ice impacted. The very first person, Dallas. I know you guys got a massive amount of ice. So, thanks for coming on tonight. And um, and I would imagine, that it's going to be shared as well for those that lost power. Debbie and I have been slacking back and forth all day. I still have power. I think we can go tonight. So I'm in Virginia. I'm surrounded by trees, and that ice starting to really start to get heavy on the tree branches. So if we should lose power in the middle of this, I will I will record the presentation on my own and get it to Debbie, and she'll send it out to all of you. So, anyways, what we're going to be talking about tonight is very near and dear to my heart. There's been so much talk about the changes to the federal loan system, and those that are on Debbie's, yes, you're hearing about it. The majority of parents are not. The high schools aren't addressing it. The colleges aren't addressing it. And it's just a real shame. A lot of people are going to be caught very much unawares. But the big thing that they're going to be caught unawares on is our topic for tonight, which is the changes to the repayment plans for Parent Plus loans. So let me, while we're chit-chatting, and I can't talk and click at the same time. So I'm going to start Debbie, can you see the slide?
Not yet.
Let me do this again. So I'm going to share, and there it is.
Yes, it looks like it's coming on now.
Okay. All right, so I'll
Yes.
put it in view mode in just a second. But we're going to be talking about the federal loan repayment changes. And there's just like everything else, there's a deadline of June 30th, because as of July 1st, everything is going to be in place and there's no changing at that point. So I'm going to let me go ahead and get into this. So Debbie, is that showing now?
Yep.
Okay,
You
great.
clearly see it.
And so, I like the dramatic, it's an emergency briefing of the Parent Plus loans, but it kind of is in a sense because it's going to have a major impact on your financial future as parents, especially those that might be fairly close to retirement years and you're still going to find yourself in repayment. So, this hard deadline of June 30th, what am I talking about? So, as it stands right now, in the way that it has been, there for Parent Plus loans, there was a income-driven repayment plan called the ICR, Income Contingent Repayment. And it gave parents the opportunity to be able to stretch their payments out according to their income and have a lower income. The downside is, the interest is still going to continue as far as you're in like a negative amortization loan, but it gave you some ability to maybe change your circumstances, find a better job, whatever that you could take advantage of if there was any
So it
job.
lowered your monthly payments, but it stretched them out, right? So you ended up probably paying more interest.
Well, you weren't actually paying the interest. That's the thing. But
Oh.
the interest was accruing. And then at the end of that time limit, there would be a taxable consequence on the forgiven debt. So it would be forgiven, but then you'd have taxes that would be due on that debt. No different than, back in 2008 when everybody was foreclosing on their mortgages and eventually the lenders caught up with everybody and said, "Hey, listen, you have a taxable consequence on that forgiven debt." It's the same thing with the federal loans.
So before going into that program, somebody can actually figure that all out.
Correct. And so the case study that I'm going to show tonight, we're going to get into all of that. So that's how the current system is. You could go into the ICR and have that ability to have the income-driven repayment if you could not afford that standard 10-year repayment. What's going to happen going forward as of July 1st, there is not going to be an income-driven repayment at all for Parent Plus loans. There will be an income-driven repayment for students for their undergrad and if they go on to grad school and such. And they can have, it's called the RAP, the RAP, Repayment Assistance Program. And actually, it works out pretty good. But I want to focus on the Parent Plus tonight. You won't have access to the wrap, not for some time. I'm hoping and praying that maybe within the next 4 or 5 years, as things start shaking out, that they will come up with some type of income-driven repayment plan to help parents out. But as it stands right now, there will not be. And so you have an ability right now between now and June 30th to take the current Parent Plus loans that you have right now, consolidate them, and go into an income-driven repayment plan.
So,
And
Luann, I'm just going to ask honestly the dumb questions because I
sure,
really don't know anything about this. So, can I do that if I'm a parent with a Parent Plus loan? Can I do what you're saying, if my student has not graduated yet?
good question, Debbie, and we'll be answering that as we go. So, it depends.
Okay.
Okay. So, I'm going to put you on mute, Debbie. Just joking. So yeah, I mean, and that's what I want to hone in. There's pros and cons to everything. And you have to look at, is this going to make sense for me to do this? Because, and I'm just going to repeat it several times. If you have to take federal Parent Plus loans, not the private lender loans, which a lot of people call Parent Plus loans as well. These are the federal Parent Plus loans. If you are going to continue borrowing, then you are not going to consolidate. Because if you go through all the trouble, and this is going to be a real pain to do this, very tedious. If you go to all that trouble and then you borrow another Parent Plus loan, it negates the whole process, and then you will be stuck in that new plan. So,
Wait, sorry, Luann, can you go back, sorry, to the slide before?
okay. Where can I can't see my,
It's down at the bottom left, or if you just hit like do you have a back arrow? Okay. Well, what I wanted to ask you was
mhm,
about the forgiveness, the public service forgiveness, because it was like what's going on? You didn't talk about that. What's going on with that?
because I'm getting to it.
Okay, fine, fine.
Okay. So now that you brought it up, I am going to mute you, Debbie. But the public service loan forgiveness. So some of you parents, it's funny. While public service loan forgiveness and Parent Plus loans where you had that ability to do it. It hasn't always been like that. It was just the last few years while they were going through all kinds of changes and such. So a parent who works for a qualifying employer, like any government entity, federal, state, county, work for qualifying nonprofits like hospitals and such, anybody that works in those areas. It's not just for teachers, but they could uh, consolidate, do a double consolidation of the Parent Plus loan, and which was a tedious process, and then be able to qualify their Parent Plus loan into a standard loan, which is a direct loan, just like the student loan, and be able to qualify for public service loan forgiveness, which means you work for that qualifying employer for 10 years, you make 10 years of payments or 120 payments, because you could have a gap at that time. But at that time, the loan would be forgiven, the balance would be forgiven without any taxable consequence. So, ironically, about 99% of the parents that I would talk to about this, when they found out that they couldn't start it until their student graduated and then start the 10 years, they said, wait a minute, I want to retire. I want to retire in 12 years. And I think you can't hold on for 2 more years to, have all of that debt forgiven. So it was kind of funny when we had access to it, nobody wanted to do it. And now that we're not going to have access to it, other than between now and June 30th, everybody wants it.
Mm.
It's the normal thing. So what you're looking at right here is the new standard repayment, which is going to start as of July 1st. And what that means is no longer is your repayment going to be based on your income or your family size, or if you are in financial hardship or such. It is going to be on your loan balance. So it's meant to pay off the loan. So if your loan balance is $15,000 or less, your repayment term would be up to 10 years. 15,001 to 50,000, 15 years, and so forth. Once your loan balance is over $100,000, then it will be 25 years that loan will go out. And at the end of the 25 years, you've paid it off and it's it's done.
Wait, so
There's
so
no,
Luann, is this automatic or you have to enroll if you don't want the standard 10 years?
there is no longer going to be the standard 10 years.
Okay, so this is going to be applied to everybody, like
Correct.
just based on
As it
your
stands right
balance.
now, yes.
So
So,
somebody just asked, just so, and you might have this as your slide, so I apologize. Is there a max on Parent Plus loans? And so I don't know if
well,
you,
you're going to see that in the case study,
okay.
but remember, this is going into effect on July 1st, and on July 1st is going to be the new limits on the Parent Plus loans. So for all of you that have students that are starting as college freshmen in the fall, your limit on the Parent Plus loan is going to be a maximum limit of 65,000 per student. So right now, there is no limit. And you'll see in the case study really kind of why we should have some limits. Okay, so public service loan forgiveness. It is disappearing for the Parent Plus. You have that opportunity right now to consolidate or double consolidate between now and June 30th if you're in a qualifying, if you work with that qualifying employer. But again, you will not be able to borrow any more Parent Plus federal loans. So, there's a lot of strategic planning that has to go into what you're going to be deciding to do going forward. So
So
if
it's really
you,
hard to say, right? Like if what's the right course for somebody without really knowing your individual
correct.
situation. We don't know how much you might have in loans to know whether it's worth it to, to be able to get the PSLF over over the 10 years and what you're gonna,
Well,
uh,
you would know how much you have in loans.
no, no, no. I'm just saying for
Oh,
us to give advice,
oh,
we can't know until we know the specifics of people's individual situations.
correct. I mean, this is financial planning,
Right, right,
strategic financial planning with people, you know, a plug for myself, of course. I'm certified as a college funding student loan advisor. Did that about 7 or 8 years ago because there was a huge problem where people
right.
didn't know
No, just that
how
sometimes
to,
we can kind of say, oh, if you fall into this bucket, you should do this. Or if you fall into that bucket,
correct.
but this is like we can't because there's just too many variables.
Correct. Correct. I mean, you really, to do yourself justice, you want to make sure that you really, it's not a whim. Oh yeah, I should do that because I saw the webinar last night. It might not be to your best interest. Um, okay. So a couple of weeks ago, the government has been in they've been in discussions and coming up with all the language for all these changes that are coming up. And I personally haven't seen the official document. It's still being revised, but all of this is reality. It's just getting down to the nitty gritty. But they mentioned that you could go ahead and start this process no later than April 1st and be able to get it done. And so my recommended deadline is that you do this no later the than the end of February because currently right now the whole federal loan repayment and the federal loan system at studentaid.gov, everything is in disarray and has been for quite some time. When the program was initially, brought up, I said all along, this can't happen. This is not going to get accepted because it's going to cost trillions of dollars if it And of course, it went into litigation and everything stopped. Well, before that happened, all of these borrowers were automatically put into the SAVE program. Some of them didn't even know that they got switched. And then 2 days before it was supposed to go live, that's when I said, wait a minute, we're going to challenge this. And so it's been in the courts for the last couple of years. And all these borrowers have been in limbo. They can't do anything. They can't make payments. For a while there, the interest wasn't accruing. And then about a year ago, they said, oh, well, we need to start charging interest again. But borrowers could not get out of the SAVE program. There is over 700,000 applications that are backlogged of people trying to get out of SAVE to get into a different repayment plan. And so now here we come with consolidating the Parent Plus loan borrowers so that they can either get into the last known IBR income driven plan or not. So my recommendation is you need to get it done as soon as possible and no later than submit this process than the end of February. I would dare say that if you follow the government guidelines saying, oh yeah, you can wait until April 1st, I would not recommend it. So, and if there is an error, all you do is you get a message, oh, you made a mistake. There's an error here. You're going to have to resubmit and start it all from scratch again. So, buyer beware. So, protecting your consolidation status, and I know we already kind of discussed this, but super important over and over and over again. If you do the consolidation because it's going to help your financial situation, you cannot borrow another federal Parent Plus loan. If you do, you will lose that eligibility in that it's called the IBR program. It's going to be the only one left. You'll lose any eligibility if you qualified for public service loan forgiveness, and all of your loans will be moved into that new tiered standard plan.
So
So,
so for the person
yep,
who might end up consolidating, but they need to kind of realize, and you've said it now multiple times, that you can't take out another Parent Plus loan because you'll kind of break what you just might have
correct,
done. What they can still borrow, but what they have to recognize is that their only option for borrowing will be a private loan, and they should just then start to be comfortable with what rate a private lender might offer them versus what
correct.
they would have gotten from the Parent Plus loan.
Correct. So for those of you, and perfect timing again. So some of you are married and you file your taxes married filing jointly. Now, so if you are married, or maybe you're divorced and the two exes are getting along and such, so the other parent can borrow the federal Parent Plus loan for the student that, say, is a junior right now and they have another year left of school. And there's, they go to try to get a private lender loan, and maybe the interest rate is going to be at 15% because they're looking at your debt ratio as well as your credit scores and such. And you're thinking, oh my gosh, I didn't realize it was going to be that high. Well, remember, they're looking at your debt ratio. So if you already have Parent Plus loans, that's going to be part of your debt ratio. And so possibly the other spouse could then borrow in the Parent Plus, but they're going to automatically be in the new standard repayment plan when it comes time for the repayment of that loan. So sometimes it is beneficial from a payment standpoint if you file married filing separately. I am not giving tax advice. That is the one nightmare process that I am steadfastly never going to get into is taxes. But as far as the federal loan system goes, right now, it can still make a difference for Parent Plus loans when you consolidate, if it's going to make sense for you to go married filing separate instead of married filing jointly. Once July 1st hits and all we have is the standard payment, the new standard repayment plan, it doesn't matter because it's not on your income. The calculation is based on the amount of the loan balance. So, and we'll show, so perfect. I keep talking about the case study. So I'm going to, I might have to relog into my software real quick. Let me just see if it's gonna let me move. Yes, okay. So let's go. Debbie, I'm going to bring this. I'm actually going to stop sharing on my where's my, I'm going to stop sharing for just a moment. I'm going to bring my software. So this software, folks, is what I have used for a number of years. And we're going to go into a case study, show you exactly what I'm talking about. So bear with me. Debbie, can you see the software?
It's coming up. Yes, now we can.
All righty. So I wondered for a little bit if I should use this example because it's a fairly high loan amount, but I realized this happens to a lot of families with multiple children. So this is a married couple. They file their taxes, married filing jointly. Right now, if they were to start repaying their loans, which is the balance, hope all of you are sitting down, is over $400,000. So if they were to start this repayment right now, their monthly repayment for a standard 10-year repayment would be $5,435. So, and their income combined is $234,000.
So just to reiterate, this is maybe an extreme example, but it's actually a real example.
Correct. This is real, and I've talked to 4, 5, 6 people in the last couple of months that have similar balances, and one actually had more. So,
Scary.
you get 2 or 3 kids, and it starts to add up. Okay, so this is where I plug in, their joint from their tax return, and how much they paid in taxes, what their itemized deductions were and whatnot. So it shows me, okay, what's their tax liability? And then if we were to file separately and break that up, how much of a difference is there going to be? So again, not giving tax advice, but so in this situation, they're going to end up paying about $3,000 more in taxes. And there'll be a couple of benefits that they will lose married filing jointly if they go married filing separately. So again, it's going to depend on, well, what's the differences in the repayment? So keep that in mind as we go forward. And so if you see here, studentaid.gov, you can log into your FSA account and you'll see your loan balances on the screen. Then you go into your dashboard And you can see where there's going to be a download to download your a data file that is all of your loan information. And it's a typical data file. It's just a lot of lines of numbers and such. But the bottom line is you want to make sure that your loans that you download that data from FSA and the loans that you have listed with your loan servicer are the same. So it's a good way to check. And with all of my clients, we do this on an annual basis, just to make sure we've got everything, we've got it saved, because some of these accounts have a little bit, all of a sudden somebody says, my information is lost when they change loan servicers or such. So have a backup. But so their current loan total right now in this scenario is $451,000. They average out the interest rate, and there was that payment that I mentioned. And then it just shows us all the different loans that they have or that borrower has. And we're not going to worry about refinancing. So here is an example of the new and old loan repayment options that we have or are coming to. So right now, this new standard, that's going to be in effect as of July 1st. So their payment, remember it was what, like $5,400. If they miss the deadline, their repayment is going to be $34.64 per month. So you're thinking, well, geez, you don't know, you're not a very good math person, because that's like $2,000 less a month. So hold that thought, and then you can apologize for thinking don't know my math, which I hate math. I always have a calculator handy, always. And the RAP, Repayment Assistance Program, it's not available for Parent Plus loan. It's only going to be available for the students. Now, the IBR method requires enrollment before June 30th. And so this column here, this 1762, is the payment if they were married filing jointly, and it can go as low as $62 married filing separately. Remember, the borrower's income is $30,000. Both their combined income was $234,000. So if we go down here to the standard 10-year extended, graduated, and such, all of these are going away. So they've been trying to, in giving credit where credit is due, trying to simplify this process, because it has been just a very complicated nightmare with all these different plans and people not knowing which way to go. And they were told to get into one, and it recalculated and started them from scratch again. It's just been horrendous. But if you see this ICR, and I'm just going to hit that there. If the ICR, Income Contingent Repayment Plan, is what they have right now for the Parent Plus loan, and you have to, I'm going to get in the weeds just a little bit, but when you do this consolidation process, you have to go and make one payment in as the ICR payment, and then it will go into the new IBR. So again, there's a difference, pretty big difference between the married filing jointly and married filing separate. And so this $36.49 payment, that's monthly for 20, 25 years or so, we'll show that example in a second, the $3,000 difference, the tax differential, that's only one. That's not monthly. So you can see that, for some, it's going to make a big difference. All right, I'm going to go back and plot that there. And now I'm going to show you something that will be a little bit easier to follow. I like charts. And we're going to go into, so we'll look at the new standard for this particular family. Remember, $451,000 in student loans. So if they go and choose to, I'm going to stay with the new because I have other students that I'm going to be borrowing from. The payment for just this balance of 451,000 is going to be 34.64 per month. And it doesn't matter. It says over here, tax filing status. Doesn't matter if they're married filing joint or married filing separate. It truly doesn't matter. The payment will be the same. And I'll show you that this is going to go out for 25 years. Now, can you pay it off quicker? Yes, you can. Penalty. So what's the consequence of this? There's no outstanding balance, so there's no forgiveness, and there's no taxable balance. So there's no closure, but you've just paid over that 25-year time frame just over $1 million.
Wow.
$588,000 of that is in interest. So that's what the new standard repayment is going to look like for this particular family of 451,000. Now, if we go to the IBR new, so then we're showing the range of $62 per month to $5,200. Again, you can make a decision if you're going to go married filing separate or married filing jointly. So of course, that $62 payment is on married filing separate. And that is going to go out for 20 years. And so that borrower would have paid just under $5,000, making those monthly payments of $62 for 20 years. But now they're going to have an outstanding balance of $1 million because they weren't making the principal or the full interest. So it gets taxed on and continues to grow. And so there's going to be a possible tax exposure of $400,000. And before you say anything, I've got an explanation for that. So bear with me. And so, we look at that and think, oh, what's going to be worse? It's kind of like that 6, 7 that I never really quite understood what all the kids are talking about, but it's one or the other. And so this plan gives this family an opportunity to have some breathing space while they figure out what they're going to do. Now, also something else for you to consider is with the federal loans, Parent Plus loans, as well as the student loans, you do have the death and disability.
I was going to ask about that. It's a horrible thing to ask about, but
I mean, it's true. So
yeah.
I've had a few clients that have passed, and those Parent Plus loans were immediately forgiven and wiped out. There was no consequence to the surviving spouse or to the student. This particular family is going through the paperwork for qualifying for Social Security disability. So dad has been sick for quite some time, and we knew that. So that's why he has been the borrower. And it's time that he can now submit that paperwork. It's going to take take a couple of years for it to get approved and whatnot. And so there's, going through that process. But eventually, so during that time, they can keep that payment to $62. And any other monies can go towards, their medical expenses or, retirement
But even if the borrower passes away before the
before
uh,
the 20 years in this
20
case.
years, there still could be a tax exposure. Is that true?
No, there is
Oh,
no, it's forgiven and there is no taxable consequence.
wow.
Unless you live in Mississippi, then they have
Okay.
a state tax. But so keep that thought while we go to finish up with this, and I have another explanation. So, it's quite a difference. Now, if we go to the ICR,
Wait, so can I just ask before you go to another example or another plan on the one that you just showed where it was, what was it, $62 a month and basically
mhm,
$400,000 tax exposure at the end? In theory, if they went that way and the borrower survived the full 20 years and they had this tax exposure, I guess I assume the advice would be that they need to put
they,
money aside over those
yes,
20 years, knowing that that tax bill is going to come to be able to cover
correct,
the tax bill.
correct.
Okay,
They have that opportunity to put that into a side fund.
right.
And if they don't have to use it to pay for taxes, then that money can be used for the surviving spouse for retirement.
Okay, right. And there's just one other thing, which is a complete unknown to all of us over the next 20 years, is how federal policies will change.
Correct. Or
So,
what the tax bracket, what the tax rates are going to be at that time.
right.
So a lot to think about, but it gives you some breathing space. All right. So before I'm going to go to the ICR because we have to make one ICR payment. And so that can be, let's just say married filing separately. It's going to be $249. We have to make that payment and then we can put it into the IR. But let's just say that they didn't decide to do the married filing jointly, or I'm sorry, married filing separately. Um, we can't get our taxes done. We're just going to go ahead, submit it. We'll do married filing joint, and then we'll change it. And you can always change it. But the problem is, now your payment is going to be $3,700 a month.
This is married and
Married
filed.
filing jointly with the ICR. And the thing is, if we go back to the other slides, how in disarray the whole department is as far as managing the applications and such. It will could take 3 to 6 months or longer before that new application gets processed. And so in the meantime, you're paying that much higher payment. Okay. So, sometimes, again, you have to weigh the odds. What am I going to lose by going married, filing separate? And I haven't found too many times that it wasn't going to be, a positive to do that. But, everybody's different. Every situation is different. Okay. So I'm going to now, if I can find it in my screen, I have so many things open here. I'm going to go back to are you seeing the case study 400,000 real? Okay.
Wait, well, this was
I'm
the
gonna
ICR one.
okay. I'm gonna stop sharing for a moment and then I'm going to go back to the slide. Now we're back to the slides.
Yes, yes.
Okay. So everybody is concerned about, my gosh, if we have $200 or $400,000 of a tax liability, I don't know if this is going to be worth it. So there's something, it's the IRS Form 982. It's called the insolvency exception. And I learned this from a CPA. So what they do is they total up all of your debts. And I went and looked at the application, and it's your mortgage, any loans, car loans, credit loans, student loans. You take all of your assets, and then you take your debts minus your assets. And so in this case, you're insolvent by 150,000. So there's up to 150,000 of forgiveness is tax-free. So
Mm.
again, it's calculating, and yes, tax brackets are going to change and such, but the
So
reality,
potentially 150 could come off of the 400,000.
correct. Or, more or less, depending on how, if you don't have much in the way of assets.
Somebody's asking, is your 401k considered an asset?
You know, I'm, I don't believe that it is, but again,
So this might be, but we're not 100% sure, non-retirement assets.
correct. So, that is a question for the tax person. Because I just learned of this tax insolvency exception just a couple weeks ago, talking to a CPA, because my concern was the tax consequence and making sure that my clients are saving in that side bucket and such. And he said, "Oh, but by the way," and so it's there, and it's something to consider. So, can you do this yourself? You absolutely can. You can go to the studentaid.gov site, not right now because it hasn't been updated with all of this, but soon. Is it complex? Yes. If you're the kind of person that really gets into all of this stuff and you do your own taxes, and you take your time and read directions, um, you could do this. And so it's just tedious, and it's just knowing all the ins and outs. If you're not that kind of a person, I would highly advise you to meet with a professional and get some assistance with it, because it is going to be complicated and it
So,
is important.
Lorraine, there was a lot of questions. I'm not going to ask a question yet, but I'm just
We're
wondering,
almost done.
is there some framework, maybe you have it on a page, some framework to give people advice? Like, for example, let's say I have like I'll have 50,000 in Parent Plus loans when my student graduates. Um, should I like be bothered kind of doing these analysis? Or is it like, if I've got 200,000 or more, you should definitely be considering like, looking at these different scenarios.
I guess I don't understand the question. Yes, I mean, you have to. So, um, if you have, whether it's 50,000 or 200,000 right now in those loan balances, you can, if you don't have access to me or my software, um, there are calculators out there that you should have been plugging in before you even took any of these loans, whether they're Parent Plus loans or private lender loans or such, to get an idea of what your payment would look like. So you can go to any kind of a loan calculator and look at what my $50,000 federal loan will be. You take the average of the interest rate. So like say you've got 3 years of different interest rates, 3 years of loans. You average the interest rate, and it's always going to, it's not like you're trying to refinance to a lower rate. It doesn't work that way. So if it, just like this was, I think, 7.97%. If it it's not going to go lower. It's, so, and then it's going to tell you what my payment is going to be looking like. Like I said, I always have my calculator. So let's say $50,000 loan amount. I'm going to go 8%, 8% interest, term 120. And so that monthly payment would be 606.64. And the I'm just trying to get to the how much would you pay in interest? So you would eventually have paid back $72,796.56. That would be the 50,000, so $22,796 in interest. And that is your standard 10-year repayment. But if you're going to be in the new standard repayment, it's not going by income. So if you're at a $50,000 loan, it's going to go to a 15-year payment, not a 10. Now,
But can't I still pay it off in 10?
you can. So there's no repayment penalty. But your payment is going to be, okay, so let's say 50,000 loan amount. Term is 180 months. Interest is, what did I say, 8%. So that payment is going to be 477.83. But the amortized interest is going to be $36,000 if you take that 15 years. So hopefully that makes sense. So it's not going to be calculated on your per se, as it is going to be the loan amount is going to determine what the length of that payment will be. And if you go that full length, then you're going to pay a lot more in interest, which is, pretty normal.
Right.
Okay. So right now, I mean, is the time to make sure that you know what your loan balances are, and should you not refinance, but consolidate, because you'll have that ability to have a lower payment than what you have now, or maybe the payment would be fairly similar. You've got to run the numbers. And if you're going to do this and going to go married filing separately, you need to get the taxes done as soon as possible so that as all of this is going in, it's using this 2025 tax return as married filing separate. Because if it goes in married filing jointly with, say, 2024's tax return, it's going to go in with the most recent tax return. And so then your payment is going to be on that both income if you are going to consolidate. And then it could take, could take 3 months, it could take 6 months. There's no way of knowing how long it would take to resubmit with the new taxes once you have completed your 25 tax return. Does that make sense?
Mm-hmm, mm-hmm.
Okay. So, and again, you want to try to get this process done. My recommendation is by the end of February, no later. The government is saying, you have until April 1st. I just don't trust that and we don't know if you're in the system and it hasn't been processed by June 30th, are they going to allow those
Right. We don't
applications
know.
that maybe
Right.
have been stamped and are in a queue or whatnot? We just don't know. Um, and again, just you cannot borrow any new Parent Plus loans for uh, child or for younger children. So I was talking to somebody the other day, and we are waiting for the spring loan disbursement to show up in the FSA data system. And then we're going to start the consolidation. And then, so the parent said, and then I'll just go ahead and take the Parent Plus loan again for the fall of next year. And I said, no, 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 no. You didn't listen. um, you cannot take another Parent Plus loan. Your spouse can, or you can do private lender loans or look at other resources and such. But if you do this, you will undo all of the standard or yeah, the standard repayment. And so then she said, well, and her income is zero right now. She's not working. Um, Stayed at home with the kids. Eventually, she wants to get back to working. She's an attorney. And she said, well, what would my payment be if it changes? And so, we just kind of changed the software around a little bit and showed the differences in, with her being married, filing separate. Um, and life is going to change. Your income will go up. If you're close to retirement and maybe you start receiving Social Security, that's going to increase your income. And every year you need to recertify your income to reflect, is the payment going to go up or is it going to go down? That is for the loans to be consolidated between now and June 30th. After July 1st, there is no income recertification that's going to be required. That will be done away with um, um, because it's going to be on the balance, not on the income for Parent Plus loans.
Right. Okay, so we have a lot of questions
I
and we may
bet.
not be able to answer all of them, but maybe let's just step back a tiny bit because I see that there's questions here of people just not even understanding what the new caps are and if they already have a student in college and they have a Parent Plus loan, do these new caps apply to them?
So if you have Parent Plus loans right now with a and so
Wait, you cut out. Wait, yeah, I assume you said if you have Parent Plus loans with a current existing college student.
correct. So you will be grandfathered in to plan where you can borrow more than the new limits. You can,
Let me just maybe separate this for people.
correct,
There's changes to borrowing, and then there's changes to repayments.
correct.
And I would kind of like separate them for now. So right now, Luann is just talking about the changes to what you can borrow. So listen to that, and then we'll talk, and then we'll kind of summarize the repayment issues.
Okay, perfect. So if you have a student and they've taken, and so and initially they said if the parent takes out a Parent Plus loan, then they're going to be grandfathered into the current system, continue to borrow more than the new caps that are coming up.
Right. So the current borrowing system, that's what,
Borrowing,
yes.
yes. And so then once you're done with that student, if you have other children that are going to start, next year or the year after, you are going to have, you're going to be limited to that $65,000 total balance per student.
So you can only be grandfathered in on your existing student. It's not like a family
Correct.
gets grandfathered in forever. It's
Correct.
just that for existing college students, if you have a Parent Plus loan, you are grandfathered under the old Parent Plus limits, which in all honesty, there were no limits. So
Correct.
you can continue to take out a Parent Plus loan without limits if you don't want to take advantage of any of the repayment programs.
Correct.
So that's where the two start to connect.
Correct. Yep. So now they're saying, and I haven't seen it in writing yet, so they're saying that the parent does not have to have had a Parent Plus loan as long as the
The student,
student
I have
had,
heard that.
I've heard it, I haven't seen it.
Yes.
Okay. Um, that's how we got into trouble with Save. But so you can continue to borrow under the current unlimited, cost of attendance minus whatever aid that the student receives. You can borrow what that gap is.
As
Uh,
long as you don't want to take advantage of any of the current repayment programs.
correct.
So
There's
that's where the
only,
big decision comes in.
yep, there's only one repayment program, period. You have this small window of opportunity and then it's gone.
Right.
So you, if you take advantage of that consolidation and your student is still in school, you as the borrower cannot take another Parent Plus loan without negating everything that you had just done. And everything will be in the under the new standard repayment plan.
So basically, again, I'm just kind of summarizing like if I was in this situation, I would probably want to analyze the advantages to me for the different to take advantage of the repayment programs the way they are today versus the way they're going to be.
Correct.
And if I saw a benefit to, being in continuing in one of the current repayment plans, I would need to, go through the steps that you've talked about. But I would also need to keep in mind that if I'm going to take advantage of these repayment plans, I will no longer be able to take out Parent Plus loans if I need them for this existing student.
Correct.
So there's kind of multiple decisions to be made here and multiple analysis to understand, what my needs are.
Correct.
Okay. And I'm just going to laugh for a little bit, but we're not even going to touch it. There were some questions about graduate loans. I'm sorry, we're going to do that a different day because it's
Yeah.
just that is another mess. But we
The
can't talk about it
easiest thing
today.
to say for this conversation, for this tonight, there are no Parent Plus loans for grad loans.
Right, but to even just talk about the changes to grad
Correct.
loans, that's like
No.
another. Well, sorry, it's
Yeah,
another topic, another evening,
definitely.
another night. We'll have to have drinks, but okay.
Yes.
Okay, let me go back and start like asking some of the specific questions. Okay, so due to the new max limits for the Parent Plus loans, is it recommended to take out a Parent Plus loan before July 1st to be grandfathered in? If so, what is the bare minimum you can borrow during an undergrad?
Okay, so we had just addressed that. Supposedly now, as long as your student had taken their 5,500 or 6,500, their student loan, then if you need to take a Parent Plus loan, you'll be grandfathered.
We think, but just to be fair,
Just to
at,
be just
at
to be on
some
the safe side,
right,
I have been telling parents to let's take out $1,000.
I think I was just going to say, I think you can take out, it's kind of by school. Some schools have a 500 minimum, but just to be absolutely safe, you could take out a $1,000 Parent Plus loan and you will be
And do not pay it back
right, and you will
before.
be grandfathered in. Do not pay it
Yes,
back before July 1st. Maybe if you want to pay it back next year, like, but
Do not. I've seen a few people in, the threads, the chat threads, and oh yeah, I took a $500 and then I paid it back, as soon as I
no,
got it.
it's got to kind of be on the books.
Yes,
Yeah.
yes,
Okay.
it makes no sense.
Okay. Okay. Here's another question. If we may, let me just read it first, make sure we didn't already answer it. If we may take out more. Okay. So this is this we've reviewed this, but this is a good like question to just like sink it in. If we need to take out more Parent Plus loans because our kids just started college, are we out of luck on the repayment program this webinar is focused on?
Yes.
If you need to take out Parent Plus loan. So this question of do I need to take out Parent Plus loan is also like a kind of hard one to answer because you may or may not, we don't know, get a better or a similar rate from a private lender. So I wouldn't automatically say like you have to take out a Parent Plus loan because I don't know what your credit score is. I don't know what your debt to income ratio is. You know what I mean?
Correct.
Like if you could get a similar rate in a Parent Plus loan, then maybe that's the route you go for future loans. And then you could, take out or deal with the current Parent Plus loans in some of the options we were talking about tonight. So again, that's just another factor to throw in.
Yep.
Okay. Um, if I consolidate for PSLF and then make one ICR payment to get on the IBR. This is like you can almost make like a little comedy act with all
Yeah.
the acronyms. But okay, let me start this one over. If I consolidate for PSLF and then make one ICR payment to get on the IBR, can I then put that repayment on in-school deferment? So that was answer this question, but there are a lot of questions about do I have to start repaying now?
Oh, yes, you have to start repaying now.
Okay, so that's another decision because
Correct.
I think a lot of people think like, which is true. I thought I had like I could postpone repayment until my student graduates. In theory, yes, but you can't take advantage of any of this
Correct.
unless you want to
Yes.
start repaying now.
So for the Parent Plus loan, yes, if you do the consolidation, you are making that repayment. You're starting that repayment process now. So for PSLF, the reason that we say, well, once your student finishes school, then the process starts because most people have to wait. They want to wait until their student finishes school before they start the repayment because their student, in their mind, was going to be helping them make those payments. But if you can qualify for PSLF and you do this consolidation and do all the right steps, you are starting that repayment now. And so your student could still be in school, but you're going to have to use a different way to pay for their existing school time.
Okay, it's kind of a similar question, but I think it's worth asking. If I already paid my student's spring room and board, tuition room and board bill in full, can I still apply for a $10,000 Parent Plus loan so that I can be grandfathered in?
Yes.
Okay. And again, it
I mean,
doesn't, you don't have to
you
apply for 10,000. It could be $1,000 Parent Plus loan.
And if you're, and you know, I have to go with what I've seen it in articles by, you know, um, gosh, I can't even think of his name right now. Adam Minsky. So
Yes, a lawyer.
he's an attorney that specializes in student loan bankruptcy. Getting, so we've been told for years that that can't be done, but obviously it can. So he's very much into all of this. And he is who brought it up that you can, as long as your student has taken a federal student loan themselves, that the parent will be grandfathered. into the current Parent Plus loan system. I personally am still saying, you know what? I just don't trust. We were supposed to go with Save. And there was the big thing about, Save was going to save everybody from all of this interest. And 2 days before it was supposed to start enrolling and people were going to make payments, and it stopped. So I just don't trust the system. And that's why I know that I will recommend to every person that I speak to, take out $1,000 Parent Plus loan and just have it in your back pocket if you need it for this grandfathering. You don't want to find out 2 days before June 30th that, oh, you know what? We really decided that you have to have a Parent Plus loan to be grandfathered. I just don't trust the system.
Okay. So the next question somebody had is, if they have multiple students, maybe some graduated, some are still currently in college, and they've got Parent Plus loans for multiple students, can all of their Parent Plus loans be combined together to do this analysis, or do they have to do it individually for each student?
No, no, no. It's all consolidated. So the
Okay.
example that I showed you was 2 students. Um, so you consolidate all of them. So because that loan data that you saw, that's all under your FSA
Right.
because those loans are in your name. It's not individualized to the student. Those loans do not show up in the student's FSA data.
So if I took out Parent Plus loans for a student who already graduated and I have a student who's still in college, I could consolidate, and I'm dealing with all of those loans together. But again, I still need to think about, do I need to still borrow for the existing student in college? And if I do, I can't take the Parent Plus loan if I want to take advantage of the repayment programs. So I got to think now, how am I going to borrow whatever I might need to borrow, because it
Correct.
can't be from the Parent Plus loan. Okay. Um, okay, good question. For the PSLF, are you saying that after the deadline, I won't be able to get any more federal loans? Like if they go into the PSLF program,
If they if they consolidate their Parent Plus loans and they qualify for PSLF, if they take another loan after July 1st, then they are no longer, none of what they had consolidated is going to be in qualifying for PSLF.
right? But if they want to maintain the PSLF and they still need to borrow, they just cannot do it through the federal government.
Correct.
Right. Um, okay, this is a repeat, but let's just
Mhm.
ask it so that we can kind of get again sink this point in. I have an undergraduate in the second year of college. I've already borrowed over the $65,000. Does that mean I can't borrow more for the rest of the college years?
No, you are already in the current system as we have it. So you are grandfathered and you can continue to borrow whatever the limit is for, there is no limit in a sense. Um, the cost of attendance minus any grants or aid that you receive from the school will equal the need or the gap of what you need for a loan. You can borrow up to that amount. And if it's over 20,000 or God forbid, if it was over 65,000, you can still borrow it because you're grandfathered into the current system. If you have a brand new student that starts in September as a freshman, you will be under the new Parent Plus loan limits. You cannot borrow more than $20,000 in a given year, and you cannot borrow more than $65,000 for that student. So if you're going to be borrowing, say, you have a need for $30,000 per year to borrow for that student, you're not going to get that borrowing between your parent plus loan limit and the loan limits that are on the student. The student has 5,500 as a freshman, 65 as a sophomore, and 7,500 each year as a freshman.
Somebody's asking if we took out 25,000 and the student isn't graduating until 2027, which is next year, if we pay back the 25,000 before that time, before they graduate, are we still charged interest?
Oh, I thought it was going to be something else. So you're being charged interest as the loan is dispersed.
Right.
So unless it's a subsidized loan, which you
Which
can
it's
only get a
not because it's
subsidized loan.
25,000. Yeah.
Yeah, you can only get a subsidized loan, the student can. The
Right.
parent plus loan for you, if you're borrowing 25,000, the interest starts to accrue as soon as it's dispersed.
Right. So just so everybody understands about federal loans and private loans, you're except as in the case what Luann talked about for if it's subsidized, if they are unsubsidized loans, parent plus loans, or private loans, when the money is dispersed to the college, interest starts accruing. But you have the leeway of not paying anything until your student graduates, and usually even 6 months after your student graduates. But even though that's what you're allowed to do, we always highly recommend, and most college financial planners will recommend that you pay something towards the loan while your student is in college. So interest will be accruing. You just don't have to pay. But what happens is if you don't pay the interest that has accrued by the time you have to start paying back, it's called capitalization. And that interest is added to the principal of your loan, and you then start paying interest on interest.
Correct. So you as the parent can set up that you're going to pay $25 a month towards your students' loans to help manage so that the interest, there won't be capitalized interest once they have graduated. But you've got to remember, you're going to have to do that for each new loan every year. So $25 the first year, now maybe it's $50 a month, then it's 75, then it's $100 a month to keep up with the interest. It might be a little bit more, it might be a little bit less, so that when they graduate, they will start off with a fresh 27,000 without any capitalized interest added to it. And that helps your student quite a bit.
Okay, here's a question. If I took the first Parent Plus loan in September, and I plan to take one for the next 3 years, what's the big takeaway from what we discussed tonight for
I
this
missed what you
person?
said, Debbie.
Sure,
They take,
sure.
yep,
This is a
first year.
parent. They said
Mhm.
if I took my first Parent Plus loan this September, and I know I'm going to have to take a Parent Plus loan for the next 3 years, what's the big takeaway for me that I should think about from tonight's discussion?
So you don't have to worry about consolidating anything. And then once your student graduates, your Parent Plus loans, if you can go 6 months grace period, and you'll have to start repaying. And then depending on the balance of your loans will depend on which tier that you'll be in on the new standard repayment. So it's not going to go by your income so much as it will the balance and how many years. So if we, um, I'm going to just stop sharing that. And why is this not? I was just going to, find Okay, here we go. I'm just looking for the tier schedule. So if you see that repayment term, if your loan balance is 50,000, it will go out for 15 years. 50,000 $1 to 100,000 20 years, and if the balance is over 100,000, the loan term will be 25 years. And then they'll calculate what your payment will be through, for that. Remember, calculate the average interest of all of the
Right.
loans, and the excuse me, um, the um, the loan balance, the interest rate, 25 years as an example, and that will give you your payment on
That's going to be your payment. But my personal advice would be if you can pay it off in fewer,
Oh,
if
sure, absolutely.
always consider if you, that's just, they're saying that that's the minimum that you're going to need to pay. But if you can pay more than that, you absolutely should. Because all
Correct.
they've done, they might have made it sound like, oh, we're making this easier for you because we're lowering your payment. But just keep in mind, you are paying more interest on that loan.
Correct. So, but you also have to realize that that is going to be your payment. There is no adjusted payment. There is no hardship. There is no, the payment is not calculated by your income. And as the cost of school has gotten higher and higher, and parents have borrowed more and more, those payments, those standard 10-year repayments, got higher and higher. And that's where all of these income-driven repayment plans came out to help families manage the payments better on those lower incomes. But now this new tiered plan, it's not going to go on your income. You're going to be told what the payment is, and you can make extra payments so that you're not going to pay as much in interest. But you can never say, hey, in the current system and in the past, you could go into, if you were having difficulties, you could go into forbearance and, for up to 3 years. Your and interest still compounds, but you're given some breathing space if you lost your job or such. With this new plan, from what I've seen, you're only going to have one year of grace and only one time in the lifetime of that loan.
So somebody is asking, so I'm going to guess they have two different students. One student is actually helping to repay their Parent Plus loans, and so they're wondering, can they like do some of the things you suggested tonight, but only do it with some of the Parent Plus loans, not all of them? Can they consolidate some of the Parent Plus loans and not all?
No,
Oh, I didn't know that. So you have to consolidate all.
right.
Didn't know that. Okay.
So it's all or nothing.
Uh-huh. Ooh.
So then you just, I mean, you could probably figure it out, but not on this call, you know,
Right, right.
as far as, it would be quite a bit of calculating, but
Okay, so last question. What if the Parent Plus loan is taken out under one parent's name? I'm assuming the option of tax filing jointly or filing separately is not applicable. Like, so basically they're saying they're married, but it was only one parent who kept taking out the Parent Plus loan.
right.
Does
So
the idea of parent of like filing separately or jointly, does that matter since it's only the one of the parent who has the Parent Plus loan under their name?
So the parent who has the loan in their name is the borrower, and they are going to be the one doing the consolidation. So when you file married filing separate, as an example, they're only calculating that parent's income.
So I guess I'm just hypothesizing, this person
Mhm.
didn't say it, but if the parent who borrowed the Parent Plus loan also happens to be maybe the higher earner,
Higher earner. Yep.
is it going to make a difference?
You just have to run the numbers.
Right. But it might make less of a difference. But I hear it. Yes.
Correct.
I have a feeling that's what they're hypothesizing.
Right. Yeah. Yeah.
Yeah.
It's always,
If we only knew this like 5 or 6 years ago, maybe people would have been
well,
more strategic about,
exactly.
yeah.
And, that goes back to that most common statement that I wish I had started putting a nickel in a jar every time I heard it. I wish we met you sooner, because I wouldn't be here tonight. I wouldn't be in Virginia in this freezing weather. I'd be retired on a beach somewhere. But that's it. A lot of people think, well, the higher income earner of the family is going to have to be the one to take the loans out because we'll get a better rate or such. It doesn't matter with the federal loan system. Does it matter in the private loan system? Absolutely.
Hmm. Okay, guys. So I think we're going to call it a night. I wish this was less complicated. I wish um, that
You and me
it,
both.
yeah, there weren't so many hoops to kind of think through. But um, thank you, Luann, for at least bringing it to our attention that even, and like, I have to admit, for people watching, you might not have understood everything tonight. I get it. But at least maybe we kind of made you aware that there's something you need to learn more about. Um, and we will follow up. I'm going to talk to Luann after this. If the different ways that if you want a one-on-one review of your situation, how best you can get it, and other resources that you might want to look at to read up on for yourself. But if we did one thing tonight and we made you aware that if you have Parent Plus loans, you should at least be thinking and learning about what these changes are, then that's a start. But just to kind of heed Luann's advice, you would probably have 4 weeks to figure this out, to be on the safe side and if you're going to make changes, to get started on those changes.
Yep, exactly. And just be aware too, hopefully this, with all of these changes with the limits and such, the whole purpose of those 65,000 with the Parent Plus loans is because of these kind of scenarios. This is not an uncommon number of,
That's what I said to Luann when we started, like when she told me that number, I was like, wow. But if you've got multiple kids, if you got 3 kids, you can very easily see, think about it. You have 3 kids, and maybe each kid you had to borrow 30,000 a year in a Parent Plus loan. You can very easily see how you could get close to 400,000 in total that you have in Parent Plus loans.
or more.
Yeah.
And you don't think, because you're caught up in so much emotion of this college process, you don't think of, well, what are these payments going to be like once they've graduated? And this is, it's right in your face. And for those that are, thankfully, if there are people on tonight that their kids aren't, uh, they don't have any Parent Plus loans yet, and they're dismaying because I can't believe we're only going to have a $65,000 gap. What are we going to do? You're going to have to come to terms with, we may have to look at a, alter solution, a plan B. Forget the dream schools because they all, as you can see, some of those are becoming nightmares for parents as well as students. So it's meant to get us thinking and hopefully bring some of the costs down for some of these colleges. I mean, some of them this year are over $100,000 cost of attendance. I've seen at least a dozen so far. And I wish all of these changes had happened 15 years ago. We would not
Yeah.
be
I
where we
mean, in
are
all
today.
honesty, when they created the program, there should have been limits then.
Yep,
Yeah.
absolutely.
Yeah.
But
So somebody is asking, can we do a webinar about graduate borrowing? We probably can. We will look at the calendar, get something out there. But, again, let's take care of the Parent Plus and undergraduates first, but we will definitely talk about graduate borrowing because there's unfortunately a lot of changes there, and similar thinking is going to have to go on, particularly for the students who, and I want students to be able to go to, medical school and law school, and nursing, but they're going to need to know what the new realities are.
well, nursing's not a problem.
Right.
It's the it's the ones that are not going into nursing as soon as they finish their undergrad. They want to go, further into nurse whatever.
Right. The nursing graduate degrees.
Right. And give it a couple of years. A lot of those programs are going to be gone. And we're
Mm-hmm.
going to go back to where I was talking to a parent who is a professor at one of the colleges, and she said, "Why, why should we have to go on to advanced degrees for a audiologist, where it used to be they could get their degree and go into practice with an undergrad degree? But then all of a sudden, we have all this money coming from the government. And now here we are. We have to have more advanced degrees before we can get our foot in the door. And we have to go back to those days.
True.
Um, but it's going to be harder to go backwards than to go forward. So,
Right.
the kids during the next few years are just going to get stuck with it.
Yeah. Okay, everyone, stay safe, stay warm. We will
Yes.
be in touch and we will see you again soon. Thank
Thank
you,
you for
Luann.
all of you that stuck with us, and good luck to all of you.
Okay. Good night.
All
Bye.
right, Debbie.